Hi, this is Melissa Buckley with the PG&E Multifamily Upgrade Program. Welcome to the fourth in our four-part series of asset management webinars, Basics of Commercial Real Estate Transactions. Today we've got both Tony Liu and John Rockwell from Partner Energy joining us in the presentation. You've heard from both of them before. Tony is the principal engineer and president at Partner Energy, and John is the national client manager, and they'll be delivering our training today. Before we get started, I did just want to remind you about how to use GoToWebinar. So here you see the menu for GoToWebinar. You can use this to enter questions or raise your hands. Typically what we've done here is take questions as they come. So feel free to use that questions box, and I will be monitoring those throughout the presentation. And with that, we'll go ahead and turn it over to Tony. As always, we'll be posting the recording of today's presentation along with the materials within the next week or so. So Tony, you should be able to go ahead and get started. And you may need to enter that audio pin again, or you're still on mute. And I don't think we can hear you, Tony. Okay, sit tight, everyone. Sorry about this. We'll get Tony back on the line. Okay.
Can you guys hear me?
There we go. Thanks, everyone.
There we
hear
go.
You. That pin can be tricky sometimes. Go ahead, Tony.
All right. Okay. My name is Tony Liu with Partner Energy. Thank you for joining me this afternoon. This will be a continuation of our last course, which really covered the real estate pro forma. And homework assignment was given out. And I'd like to take this, at least the beginning half of this session. So I am going to start by, I'm going to show a little bit of a document here. What we covered last week was some market information. And market information, particularly multifamily, is readily available, and you can really search through different market information through the internet. The report I'm showing here is by Kasdan. Kasdan is the USC real estate school, and what they do is they do a multifamily forecast on an annual basis, and they talk about the projections for the multifamily market in Los Angeles and Orange County. So this is a good spot to look at, historic as well as projected kind of real estate, multifamily real estate kind of performance indexes. So what I'm showing here is an output from their report for 2016. and it talks about rents, so monthly cost per unit. As you can see, through 2007 to 2016, what really happened over the past almost 9 years, and what's projected to happen next year. So as you can see, it's rents are getting pretty expensive in Los Angeles for those of you who are in this area, as you may know. So rents are increasing in this area. Vacancy. As you can see, for those of you know that there was an uptake in vacancy in the 2008-2009 era when there was a bit of a real estate downturn, but we're projected to remain at historic lows in terms of vacancy rates in Los Angeles, hovering around the 4% mark. Other factors that people generally consider when looking at real estate is permits. Permits. 2009 was a recession. And permits are more or less at its pre-recession highs and exceeded pre-recession highs, up to about 15,000 or 18,000 units. Permits is just an indication about how much new real estate supply will be coming online in the future. So permits usually take 2-3 years after to become actual supply. So there's definitely a lagging factor here. So rents are high, permits are high. So it's all expected, right? People are bullish on the market, therefore they want to build because there's high rents, and therefore they're going to apply for permits on this thing. So this kind of breaks it down into more different submarkets, but average rents, you can see year-over-year change. Really, no market has experienced a downturn in rents. Beverly Hills, you're looking at plus 7%. Inglewood, Gardena, Hawthorne, you're looking at 3%. The next chart talks about vacancy. Vacancies are hovering pretty low all around the county here. And again, rent. So this is just, again, in terms of looking at real estate performance, getting an understanding about what vacancy is doing, what rents are doing, what cap rates are doing. You kind of get a better feel for, what your project will be able to do as well. So, oftentimes people in the real estate industry will look at these forecasts and they'll plug in these numbers in order to understand what their return on investment is going to be. So let's go back to the homework assignment, and I'll review this thing now. So I'm going to just kind of go over some tabs. The first tab it talks about some of the in-place rents. Second tab talks about rent comps that were done. Third tab is pro forma, kind of, all the way down from, it talks about from rent to gross potential rent to effective gross income, operating expenses. There's an energy audit tab, which asks a couple questions here. We have a rehab budget here. We have sales comps, sources and uses, and then finally a financial analysis. So let's jump into the rent comps. And I'm going to do a little bit of a refresher here, and I'm going to also give some Excel tips as I'm going along here. If you look here on the upper right-hand corner, I'll be typing formulas into here, so it'll give you some idea about how some of this Excel stuff is being done. So, one of the critical pieces here is understanding what the rents are going to be, or understanding what the market rents. One thing to do is look at some various forecasts, such as the Kasdan forecast that I just showed that talks about rents increasing and what they could be increasing to, and that could be a data point when doing a pro forma. But generally, when you're underwriting, what you want to look at is really truly understand what real rents are in the market. So this page assumes that someone's gone out and looked for similar comparable properties and tried to get an understanding about the year build, the type of class it is, the number of units, the size of each unit, and then the current market rents. So in this instance, we looked at some of the research and looked at 6 different units. And what we want to understand is on a 1-bedroom, 1-bath, what's the market rent? And then with a 2-bedroom, 2-bath, what is the market rent? So the survey was done. Here are the results. So one thing you can do is you look at the average of all these rents. So, in order to figure that out, it's pretty straightforward. You type in the formula equals average of this column here. So you get an average rent of $1,383. Sometimes it's interesting to know what the median is. So you type in the median formula, you highlight the top as well, and then you have your median rent of 1,370, and that's for the 1-bedroom, 1-bath. Then you can do the same thing for the 2-bedroom, 2-bath. So you have an average rent of 1,615, and then you have a median rent of, oops, that formula's wrong. So that formula's wrong. So I'm going to type it in here. Same number. So we know that that's the case here. When I switch tabs, what I do is I do control page up and control page down, so I can switch through these tabs pretty quickly. So what this is asking for here is on a 1-bedroom, 1-bath, what is the market monthly rent? And then for a 2-bedroom, 2-bath, what is the market average? What is the market monthly rent for the 2-bedroom, 2-bath? So I just did this rent comps. I'm going to take this average number here. So I'm going to control C. I'm going to take this value, and then I'm going to paste it here so that I know what that is. So you can do a couple things here. You can do a control C, then you go to this tab and hit control, well, you can't do that, but and then just control copy and paste. I won't go into too much detail there. But same thing here. So the average rent is here. We did that analysis, and then you can the average economic rents are as such. So the next question is asking for is what is the total monthly rent at this site, right? In order to calculate total monthly rent, what we need to do is really a equation here that just multiplies the number of units times the actual monthly rent for the 1-bedroom, 1-baths. Then you add that to the number of units of the 2-bedroom, 2-bath times the average monthly rent, and then you divide by the total rents. Right, so I'm going to use this formula here to do that. I'm going to take the sum product of these two numbers. So what this does is what I just said. It's going to take, it's going to multiply 64 times 1,197, and then add that number into the product of 80 times 1,440. Then I need to divide this number by the total units. So then I have my my total monthly rent of 1,332, and then my total annual rent is just that number times 12. So what I want to is that number times 12 times number of units, because that's the average annual. So it's fix the format a little bit here so it looks a little presentable. So $2.3 million is my total annual rent. And then I need to do the same exercise for the economic or market monthly rent as well. So I'm going to do the same formula, sum product of 64 units, 64 and 80 units, and then these two rents, and then I need to divide it by the total number of units, which is 144. So my total monthly rent is 1,512, and then my total annual rent at this site, well, the market rent is that number times the number of units times 12 months. So it's $2.6 million from $2.3 million. So, boom, boom. Okay. So I finished that section, right? So we know that our current annual revenue is $2.3 million, and our economic revenue is about $2.6 million. So let's go to the first page of the pro forma, right? So underwritten is really what we're talking about, is kind of what is there today, right? So we talked about what total rental income is going to be. So this is kind of your hypothetical, and your hypothetical is going to be this number, right? So this is the market rents. And then the actual rents is what's in place, and so we look for what the actual rents are in here. It's $2.3 million. So we have a loss to lease of $300,000. So total rental income is the total hypothetical rent that we can get today based upon a market. The actual rent is what's in place, which is $2.3 million, and the loss to lease is the difference between the two. So that means based upon where we're at today, we're losing $310,000 of value. So, according to Pro Forma, they weren't getting any revenue there. RUBS, remember that's the ratio utility billing system. So that allows us, the owner, to recoup some of the utility fees. So it's $53,000 in RUBS. Other income, this could be storage, it could be vending machines, it could be laundry. So total other income is $94,000. So total gross potential rent is the actual rent plus total other income. So we're looking at $2.39 million.
Hey, Tony,
So we have
a
some
question.
yes.
Sorry to interrupt you.
Yes.
From the previous
That's okay.
question from one of our participants, why use median versus mean for averaging rents on the previous page?
It's just another point to look at. So we use the average number. So the formula has average, but another data point is just what is the median. So it's just something to look at and something to examine. If there's a big difference, we might want to consider. We might want to do a different valuation, but they're pretty similar numbers, so it's just another way of looking at it.
Great, thank you. Go ahead.
So we're looking at vacancies now, right? So apartment loss to vacancy, that's kind of what's in place. We're giving some concessions away. That means there's maybe a free rent for a first month off, last month off, or gift cards. Some of the people haven't paid their rent, so that's bad debt. There's a one-bedroom model. There's a two-bedroom model. Maybe there's an upscale, low-scale model, so a couple of units can't be used. And then we have some of the maintenance staff staying in a few of the units. So that's employee units leased to the vacancy. So we have a total vacancy of about $340,000. So effective gross income is the sum of total vacancy plus the total gross potential rents. So we have an EGI of about $2 million. So let's look at operating expenses now, right? So we have real estate taxes. This is the tax that we have to pay going forward based upon the value that we bought it at. In California, it's typically 1.15% of the purchase price is the starting property tax, and annually it can go up about 2% per Prop 13. Salary is for people that are working on the site, so it could be your property manager, facility managers, your pursers, your maintenance staff. Advertising and promotion, these are ads that we do. Repairs and maintenance, there's some stuff that needs to be fixed on the property. This is what was budgeted. Building services, another item. Utilities, so we have $275,000 utility bills. G&A, insurance, audit and tax fees, apartment turnover. So apartments, when they turn, we anticipate a certain percentage will turn over this year, and we'll have to paint it and carpet it. Management fee, we're paying a third party to manage this, so this is a property management fee. And then we have some reserves for capital expenditures for like appliances and hot water heaters that need to be replaced over time. So we have a total operating expense of about $1.2 million. And NOI is effective gross income less expenses. So what we're going to do here is take $2 million. Oops, sorry. Let's put the formula here. Equals $2 million minus that. Okay, we have an NOI at 831. So that is our current underwriting pro forma. Now let's look at the economic pro forma, right? The key difference about the economic pro forma is that we are assuming we are getting what our market rents are. So the actual rents are 2.6. The total rent income or the market rent is 2.6 million as well. So there's some adjustments here. So total gross potential rent again is the sum of other income plus the gross potential rent. We anticipate some concessions and total vacancy to go down. So our new effective gross income is, again, the gross potential rent plus vacancy. So we're missing utilities. So what's our new utility bill? Okay, let's go to utility tab here. I will answer this first. Value of total cost savings. So installation costs, we're going to do lighting, shower heads. Lighting, it's going to cost us $72,000. Have a payback period of 3.5 years. Great. Shower heads, $21,000. Annual cost savings, $8,000. 2.7 years. So if we do this whole scope, it looks like we're spending $527,000. We anticipate cost savings of $83,000, and then a 6.36 year payback period. So annual cost savings is $83,000. So that's what our new utility expense is going to be, right? So we take the old, which is $275,000. We're going to make it less annual cost savings, which is $83,000. So our new utilities is $191,000. So there's some additional adjustments to the remaining expenditures. So our new total operating expense is $1 million, $1,040,000. So our new net operating income is gross potential rents less the total operating expenses. So it's $1.5 million. So we've increased our NOI by about $670,000. Okay, so that's kind of the pro forma. Any questions? I'll take a pause here for any questions that you guys may have. Okay, I'll keep going here. Energy audit has two questions. We talk about project cap rate and the value of energy savings. So we need some other information here to answer those two questions. So let's go to the sales comp page, right? So we want to understand what the market cap rate is. So what we've done is we've gone out to the market. We've used a resource called CoStar. CoStar is a online software tool, subscription-based, that allows you to get access to historic transactional data like the ones we find here. So this is very much information that if you're in the business, you probably have a CoStar subscription and you would buy this information, right? So we know that there have been 4 transactions that's somewhat similar to what our building is or the subject property. So sales comparable 1, it's about 110 units. Which is comparable to our 144 units. The square footage is about the same. The size of units is about the same. Sale price is in the same ballpark. And then what you have is the price per square foot is similar. So based upon the NOI and the purchase price, we have a cap rate of 5.26%. And then we examine the sales comparable number 2. So again, it's similar, but we have a cap rate of 4.5%. We have a cap rate of 5.05% here, and then a sales comparable 4 has a 4.29% cap rate. So what I'll do here is I'll just take the average. Equals the average. So I'm going to exit at a 4.77% cap rate. So in here, I'm going to say, okay, the project cap rate is what the market cap rate is 4.77. And the value of energy cost savings is the annual cost savings divided by the cap rate. So you're looking at let me clean this up a little bit. A $1.73 million value to this based upon a 4.77 cap rate. So once again, annual cost savings will decrease the expenses, which we see here, right? So it went from 275 down to 191. So our NOI went up by that amount, went up by about $60,000 from that event alone. And based upon a cap rate methodology of valuing real estate, which is taking the NOI and dividing by the cap rate, we discovered that, hey, this is worth $1.73 million. So if I wanted to, I can say, hey, my multiple on investment is my total end value divided by how much I have to put into it. So I have a 3.29 multiple on my investment, which is pretty damn good. So we have a rehab budget in addition to the energy work. So we have some interior upgrades and exterior upgrades. We looked at the sales comp already. So let's look at the sources and uses of capital, right? So we have a purchase price of about $25 million, a renovation budget of about $1.3 million. We have interest reserve. While we're fixing this up, we may not be able to make the rent because the vacancy will be higher. So we have to have some interest reserve for the pay brokers, and then there's insurance, tax, prepaid interest, and then closing costs. So we have the total project value of $28.25 million. So if we had a debt of 80%, that means that the debt is 80% of the total project value. So this is $28.28 million, and then your equity is 20% of the total project value, which is 20% times the total project value, which is $5.6 million. So for a total of $28.25 million. So we know our sources and uses balance. So that means that this is what our money's going, and this is where our money's coming from. So debt means that we're going to get a bank loan for $22 million, and equity means that we're going to somehow come up with $5.6 million.
We have another question, Tony.
Sure.
I think you used multiple on investment, and our participant is wondering if that has another name or term. We've got some folks not quite familiar with what that means.
Um, I mean, there's really, multiple investments. It's just a multiple, right? It's just one way of determining if something makes sense, right? It's not so there's no time contingent value to this, right? All this is saying that if I invest $527,000, I will increase the value of this asset by 1.7 million. So there's no time. So that just means that if I put this in, I get this out, and the multiple investment is a 3x multiple, right? So it means I put a 500, I'm going to get back 1. I input 527, and I'm going to get back 1.738 million. So it's just your value divided by your initial investment. So that's just the multiple investment. So it's just another way of looking at it, right? You can have a great IRR, but a small multiple investment because it's just because you're ignoring time. So when you're looking at investments in general, you kind of want to see both time value, which is IRR, and you also want to see the multiple because it's how else can you get $1.2 million in your pocket, right? So the argument here is, hey, it's 6.36 years payback period because you're taking time into account. And I know a lot of us have had this conversation, building owners saying, hey, 6 years is too long. I need my payback period to be less than 6. Well, your comeback is, well, fine. it's you may not get it within 6 years, but I'm increasing this value by 1.7. Where else can you increase your investment by 3x, which is a pretty good number? The other argument could be is, hey, I'm selling this in 3 years. Why do I care? I don't get my payback, so it doesn't work for me. Well, the comeback is when you sell this building, right? It's worth $1.7 million more. Right, by you investing 500, you're making it worth 1.7. Therefore, you get that multiple investment. I hope that answers that question. So let's look at the financial analysis. All right? So we're going to look at an unlevered analysis first. So unlevered means that we're not using any debt. So the purchase price. So this is going to be no debt. So no debt means that we are using just this purchase price. So the purchase price is not really, it's probably not a good word for it. It's your total use of the capital. So I need $28.25 million to make this work. So that's my initial expenditure. Purchase price, it's also a negative. So I'm going to put a negative number here. My NOI, so based upon my underwritten NOI, it's $1.5 million. So I'm going to say my NOI is $1.5 million. So I've kind of put this in for you. So every year, assuming there's no rent growth, and that's kind of a gross assumption, a bad assumption, I mean, that you don't have rent growth. That means that each year you're getting $1.5 million. And then we have a sale price, right? So sale price, again, we want to know what the cap value of this, right? So what we want to take is the NOI at the exit cap at the cap rate, and we determine the cap rate is 4.77, right? So here we're saying that we're going to sell it for 1.5 million. Our sale price is 1.5 million NOI divided by the cap rate, which is 4.77. So we're going to sell it for $31 million. So this is what our cash flow looks like. So it's a sum of all of these three items. Right, so initial outcome is year 0, we're going to expend $28.2 million. That's a negative. And we take this formula, we drag it across the whole sum here. So year 1, you're going to get 1.5. Year 2, you're going to get 1.5. Year 3, you're going to get 1.5. Year 4, 1.5, so on and so forth. Then to year 10, we're not only going to get the NOI if we sell it toward the end of the year, but we're also going to get the sale price of $31 million. So then I can take the IRR formula, drag it across here. So I have a 6.2% return on investment here. Any questions on that? Okay. So let's figure out what the debt is going to be, right? So loan to value, so this is your loan amount. So from our source of uses, we're now going to look at the levered analysis, meaning that we're going to get debt on this thing. So the loan amount is going to be 80% of the total project cost, which is $22.6 million. So we know we have a 30-year term, we have an interest rate of 4%. We want to know our annual payment. So the formula here is PMT, the rate, which is 4.5%, the term, which is 30 years, times the loan amount or the present value, which is $22.6 million. So annually, I'll be paying $1.387 million in debt service payments. So the NOI is the same as before, right? So we know that we're getting $1.5 million through the life of this project, so that doesn't change. The equity amount, so we're not taking $28 million out of cash, right? So we got $22 million from the bank, and we have to come out with what we said was $5.6 million. Again, that's a negative, so we want that to be negative because it's outgoing. So we have $5.6 million going out. We have $1.5 million in annually, and then we're going to sell it. And again, we're going to sell it for the same price as we sold it before, which is $31 million. So the cash flow is going to be as follows. So you take the sum of this. So again, you have to spend $5 million coming out of your pocket. And then you have $1.5 million from NOI coming in every year. You're going to sell it year 10, and then you're going to get $31 million from the sale price. So in year 10, you get $33 million. However, so that's cash flow perspective. But you have to consider debt service, right? So our debt on an annual basis is $1.3 million. So you have to pay that amount every year. So $1.3 million, $1.3 million every year. And then debt service coverage ratio is basically going to be your cash flow divided by your debt service, right? So banks, once again, to refresh your memories there, banks will look at debt service coverage ratio in order to determine that you have enough cash flow in the property to pay for debt. So they want to know what the debt service is going to be. Your debt service coverage ratio is 1.09. This is actually kind of low, and they may not qualify this, to be honest. They usually look for a 1.15 or 1.2, 1.25. So this is a little bit low. So you took the cash flow divided debt service, so you get your debt service coverage ratio. So one thing to consider, I didn't make you guys put this, I kind of pre-populated this formula, is you have to pay back your loan, right? So you have a 30-year amortizing loan. You've had it for 30 years. I'm sorry, you had it for 10 years, so that means you paid a portion of that principal back already, right? So I kind of calculated this for you, which is basically you still owe $18 million of that loan. So your cash flow after debt service is going to be the sum of these two lines and this line. Whoops. These two lines and this line. So you're going to outlay $5.6 million in cash. After paying all your debt and tax, your debt, you're going to have $121,000 in cash flow after paying debt service, and you're going to get that through the years. And then at year 10, you're going to sell it. You're going to sell it for $33 million, and you're going to repay the bank $18 million, so you'll get $13 million back in your property. And then your IRR is going to be the stream of that cash flow, which is 10.7%. So this basically is saying that your levered return will be greater than your unlevered return, right? You get 6.2% of the return from IRR perspective, and then from a levered perspective, and then if you put debt on it, 80% debt, you'll get 10.7%, right? So it's a better return. But it's a better return and you have less money out of your pocket, but in the end you get less money in your pocket too, right? And for this investment, I'm gonna tie this back to that multiple, right? So your multiple, so your total string of cash flow on this thing is $46 million, right? And you invested $28 million out of your pocket. So your multiple is going to be your total out, your total in divided by your total out. I'll just make this positive. So it's a 1.65, and then your multiple here is going to be, so the total string of cash here is going to be this, and then your multiple will be your total out divided by your total, I'm sorry, your total in divided by your total out. So 2.6. So that's, again, the multiple. Any questions?
Nope.
Well, if you guys don't have any further questions, this basically concludes the real estate pro forma section. I hope this has been helpful, informative, and gives you a little bit of insight toward how typical real estate kind of investors kind of look at these assets and consider the financial aspects of it.
Great, thank you, Tony. And if people decide that they want to continue working on this, the take-home document, can they still reach out to you with additional questions?
Yes, absolutely.
Okay, great.
And I can, and this is John speaking. If they want to send it to me, I can manage those questions, so I can provide my email at the end.
Okay, great. So I'll go ahead actually right now and turn it over to you, John, so you can continue with our presentation. So whenever you're ready, go ahead and show your screen, John. Perfect.
Okay. Well, hello everyone. Glad to be back for the fourth and final installment of the asset management course. So, going to bring things back, obviously, to the PowerPoint side of things and talk a little bit about some next steps and tying it all together in terms of what does it mean for an asset manager in the decision-making process, as well as talking about some exciting initiatives that are on the horizon for the marketplace right now. So if you look at our course agenda, we've tackled the previous 3 bullet points. Now we're talking about the Investor Confidence Project, or ICP, and then last but not least, these energy efficiency measures and their effects on the asset management process. So the Investor Confidence Project, it's a relatively new initiative. It was created by the Environmental Defense Fund. It was founded in 2014. Didn't really make an emergence onto the market until last year, and now throughout the duration of 2016, it has been gaining a significant amount of traction in the market, both in California and nationwide. And if you want to get more information on the project itself, you can go to their website, eeperformance.org, and it's a great resource. They have a lot of information there, and they're very responsive to talk to vendors and implementers and engineers to sort of get the word out about what they're trying to do. So what are they trying to do? It's not a new standard. It's not like ASHRAE. It's not like LEED certification. What they're really trying to do, and this is the mission statement pulled from their website, and I'll just read it. Their ICP reduces transaction costs by assembling existing standards and practices into a consistent and transparent process that promotes efficient markets by increasing confidence in energy efficiency as a demand-side resource. That's a mouthful. So what they're really trying to say is the current landscape of the energy efficiency market is crowded, and from an untrained eye, an asset manager who's focused on real estate finance and the pro forma stuff that Tony just went over, they don't know, they don't have time for, maybe they're not even interested in the sea of acronyms that we are all swimming in on a daily basis as vendors in this industry. And this is what they see. They see a maze of confusing standards and certifications and programs and whatever you may have, that's something that's added onto the pile of potential confusion. So the Investor Confidence Project aims to have a reliable protocol that they can adhere to, they being asset managers, when they're looking at energy efficiency projects. They don't have to trace this stream of certifications and standards. If they see ICP, they know a certain protocol was followed, and they can hang their hat on it. So it's a bit of an aggregator for universally accepted standards, universally accepted certifications, and making that an underwritable project with a higher degree of confidence than it would without it. Another way of saying that is they are managing energy efficiency. Well, they acknowledge that the management of energy efficiency projects can be challenging. So they want to address that problem, and they see a need for providing sort of a more universal industry level guidance for asset managers, aka non-engineers, to make those projects successful. The ICP results in the bottom two bullet points, they're driving to increase opportunities for both internal and external investment. So this can come in the form of, like the example we just talked about, an asset manager evaluating a building for an internal rehab project where they're putting up part of the money and the bank is putting up part of the money, and it just rolls into the overall sort of underlying project cost. Or it can be an external investment where they actually, at some point in time, year 2, year 3, year 4, year 5, they're going out to an external investment source and saying, I want to find a new financing to facilitate this new energy efficiency project. And ICP is in the process of corralling a handful of lenders, similar to PACE in that way, that acknowledge the ICP protocol as a underwritable standard, and they will use that as the basis for their financing of your project as an external lender who wasn't part of the original underwriting from day one. Obviously, it's looking to aim to improve building operating performance as well through the successful implementation of these verifiable savings and verifiable projects. So the idea of this streamlining and this categorization of standards and certifications and methodologies is a heavy sort of underlying theme throughout the entire ICP protocol. So you can see that they've taken that sea of labels and logos and categorized it into 5 major buckets. We have baselining the property and the energy consuming systems, which naturally feeds into savings projections. So you get the energy auditor to create the energy model simulation, to calibrate it, to identify where the savings is, and then to bridge the gap between identification and implementation. They put bid packages together and similar support items, and that feeds directly into the 3rd bucket, design, construction, and commissioning, where all of the actionable implementation is actually happening. That's a heavy commissioning-based process. You have the commissioning plan, the commissioning authority, functional testing, OPRs are developed here, and those facility requirements, that's what's passed on into the 4th bucket, the operations, the maintenance, the monitoring. And that's where the building engineer really takes over and successfully takes the plan that was given to them by the commissioning authority and implements it on the property over time. And last but not least, measurement and verification. That's its own whole ball of wax, but that's the final part of the life cycle to continue to analyze the property and the energy efficiency projects via potentially new models, new regression analysis, and making any baseline adjustments that might be needed to reflect real-world operational and implementation concerns, and ultimately confirm that everything that was set out to do from day one is actually happening via verifiable results. So that's how they like to think of things in these 5 categories. So another way to look at it in terms of the value that they're trying to add to the market is if you think of energy efficiency projects and the financing that needs to go into making those projects a reality, there are essentially 3 risk categories that make up every project: performance risk, asset risk, and credit risk. They feel like credit risk and asset risk are already being taken care of in the market through things like on-bill financing, programs like PACE, green banks that understand these type of projects. Or on the asset side, the building has been thoroughly benchmarked. There are labeling options available for that type of building. And then disclosure, both mandatory with a stick or dangling a carrot and incentivizing disclosure for building owners. But all those 3 things help mitigate asset risk in terms of making it more of a known quantity in terms of how much energy it has consumed and potentially how much energy it will be consuming in the future. So that leaves the 3rd category, performance risk. Up until now, there's not a whole lot of performance risk mitigation that an owner or an asset manager can do outside of the normal channels. You use a vendor that is bonded, or you use an energy auditor that has the proper certifications attached to their name or their resume. You've looked at their SOQ, you've gotten recommendations, that type of thing. But there's no global or universal stamp that can be associated with the performance risk when you're looking at these projects from an underwriting perspective. So the investor confidence project, they aim to completely sort of slide into that sphere and address that issue head on. So long-term financing of projects based upon the projected cash flow of the project rather than the balance sheet of its sponsors. In a nutshell, that's really the financing challenge that they're looking to tackle. So how do these things materialize both in the short term and the long term life of the project and the asset? For the short term, the Investor Confidence Project is looking to increase, well, actually, I misspoke a little bit. The short-term and long-term goals here are for the Investor Confidence Project itself and how they are looking to influence the market. So in the short term, they want to see more projects adopting their protocol. That will increase confidence in savings projections. It'll reduce transaction costs. If everybody's speaking the same language and they have something like the ICP to hang their hat on, they don't have to spend so much time and money fact-checking each other, getting second set of eyes, getting third-party verification reports, those type of things. And all of that goes towards streamlining the origination process. Time is money, and if more or if less time can be spent looking at standardized approaches and methodologies and getting straight to the point with underwriting and savings projections, then it saves everybody money. Over the long term, they're really looking at this initiative as a transformative process. The hope is that it standardizes performance data across the market, across asset classes. And that's reflected in project finance underwriting. So it becomes more of a transactional item, similar to your due diligence checklist, where it almost becomes an afterthought. The bank is asking for a phase 1, the bank is asking for a PCA. The ICP protocol becomes something that just is ubiquitous with financially sound energy efficiency project implementation and subsequent underwriting. This would enable portfolios and subsequent securitization of these type of projects, sort of a secondary market type financing option to help investors, to help owners make more money and more sense of this in the high finance market. So on a building level scale, or even maybe more project level scale, they're really looking to have the energy efficiency project stamped, for lack of a better word, with the investor-ready energy efficiency label that you see on the right. That means that the project is being undertaken and methodologies have been followed that meet the universally accepted ICP protocol. And so it's following ASHRAE guidelines, or it's following IMPV guidelines, and it's a known quantity that doesn't have to be second guessed. And you can see that it breaks down into the categories that we're all familiar with: baseline the building, conduct the energy calculation savings, and then follow that up subsequently with a measurement and verification plan. Nothing new here from a technical perspective. It's something we're all very familiar with, but it's making it a universal language that we can all follow and understand, both inside and outside of the technical market. So in 2016, they've made some great strides to integrate ICP into existing market drivers. The big one, and most germane to what we're doing right now, is the partnership with PG&E that just got announced a couple months ago. They have become part of the on-bill financing pilot program, and the protocol is being used there for building owners taking advantage of the on-bill financing program. They'll be working with energy efficiency engineers and vendors that are following the ICP protocol and making everything easier to understand, and from a centralized location where they can all reference the standards that they're using. Additionally, earlier this year, the Investor Confidence Project, they partnered formally with GBCI. So it's a natural partnership. GBCI in the world of LEED, in the world of GRESB, they're getting a market standardization level that is great for both the commercial real estate industry as an asset manager and owner, and as a technical resource as well. These kind of partnerships only bear good fruit. So ICP is something to look forward to more in 2017. It'll only get more ubiquitous and more saturated in the market as these kind of initiatives roll out. So with that said, I'm going to move on to the last phase of the course, and that's the Multifamily Upgrade Program. Effects of the ECMs on asset management decision making. A lot of this we've alluded to throughout the course. So in a grand sense, this is a bit of a review and saying something that we've been saying previously in a slightly different way. So these are the 13 primary measures that the MUP program is looking at. And so if we take these and chop them up into their building effect categories, these first 6 could be considered building envelope improvement measures by and large. And I'll be painting with a fairly broad brush here, so forgive anything that's not sort of completely technically sound, or if it seems like it's a little too generic, bear with me. It's to make a broader point. So these can generally be considered building envelope improvements. Space heating, cooling, water heating equipment, these would fall under the HVAC improvement category. Likewise, water heating recirculation, that would be a control measure. Refrigerators and dishwashers, that'd be a miscellaneous or plug load measure. And last but not least, lighting, combined indoor and outdoor. Obviously, that would be considered our lighting measure category. So how are these being thought of from the asset management perspective when you're underwriting a project? So the assumption here is that all of these measures will be having a positive effect on utility bill expense. So outside of that, how should it be thought of, presented to management, to the ownership group? Well, windows, refrigerators, dishwashers, and even lighting, to a large degree, that can be considered a cosmetic improvement. A tenant walking up to the building and then through the building, through the model units, they're going to see these things and immediately instinctively recognize them as cosmetic improvements. They won't be thinking, oh, look, it's a new window. That means the building is going to be 5% more efficient than it was prior, and that'll be passed on to me through a lower RUBS chargeback. So that'll be great. Now, some tenants may be thinking that, and when they get back home and run their numbers, maybe that is something they consider. But from the walkability perspective, from the driving through the neighborhood perspective, these can be considered cosmetic improvements that have underwriting modification effects on top-line revenue. We can ask for more rent. We can expect more lease renewals. We could even expect a decreased absorption period. And calling back to what Tony was talking about in the previous course, these kind of things can be captured on our adjustment page in the pro forma, where we're looking at things like amenities and assigning a dollar value to them. It wouldn't be out of question to see these types of energy efficiency improvements reflected in a quantitative way here. So looking at the next bunch of energy efficiency measures, I thought it would be good to consider end of useful life or CapEx improvements. It's something that the asset manager may not particularly want to do because it's a large ticket item for the budget, but maybe they have to. It's an HVAC unit that's 30 years old and had an effective useful life of 20 or 25 years. And this includes things like roof attic insulation or replacement, a cool roof or a radiant barrier on the roof, space heating, space cooling, and of course water heating equipment as well. You know, these are all larger items that are more than likely going to have a weaker payback period that's not going to sell itself during the underwriting process. It may have one of those 15, 20, 25-year paybacks that Tony had in the rehab budget and the Excel example. But you can obviously expect a lower utility expense and a lower operations and maintenance expense. So that will be reflected in the bottom line in the higher NOI like we just talked about. And last but not least, the improvements that aren't necessarily cosmetic. You don't see them walking through the building, but they're cheaper, have potentially better paybacks, less invasive, and for lack of a better word, these are under operating expense, but I know that that's a little bit of a stretch. Or it can be considered a green certification improvement. It can be something to help the asset manager get the property over the hump if they're looking to get a green certification as part of their portfolio strategy. So maybe this isn't something that they would do because it's really potentially too small for them to even be concerned about. It may have a small effect on the expenses and the subsequent NOI. It may be hard to underwrite because the dollar value is so small. You know, they don't have time, they don't have a way to quantify it. It's not something that they're interested in doing. But these are the things that take a property that's 80% qualified for LEED certification up to that 100% level. So things to keep in mind from that perspective. These are all helpful in driving that forward. So that being said, here's the list again of the measures and their categorical ECM delineation. But if we reshuffle this into the how's an asset manager thinking about it, everything gets a little mixed up. We have windows, refrigerators, and lighting, all cosmetic. We have some HVAC and some other measures in the end of useful life, and it gets a little confusing. But if we relabel it, recolorize it, it makes a lot more sense. So this is potentially how the asset manager is now thinking about these measures. When we as engineers are looking at this project from an execution standpoint, this is the checklist we're going down for the energy efficiency projects. But that's not necessarily the language that the asset managers is speaking. They're probably looking at it from this perspective. How can I bump up my rents with some cosmetic improvements? What do I have to do because it's reaching end of useful life? What's going to help me get over the hump on my green certification? That type of thing. And of course, again, these all have these sort of underlying assumption that yes, they will help your utility expense to a degree, some more than others. So in closing, just to rewind a little bit,
John, are you there? I think we might have lost you. Lost your audio. Thanks, John. I seem to have lost your audio. I can't hear you anymore, but this will conclude the webinar. I apologize, everyone, for the technical difficulties today. We will post the recording onto our website and send that out to all of you when that's complete. Thanks so much.